Hi everyone. Today I'm going to share the market review for Q1 2024 as well as answer key questions on investors' minds as we move forward. After a strong finish in 2023, the global stock market continued its bull run this year, despite diminished expectations of Fed rate cuts. Global equities gained 9% in Q1, while the S&P 500 returned 10.6%, posting its best first quarter since 2019, as economic growth continued, supported by strong spending and robust labor markets. While technology continued to lead, we saw a broadening out of the rally as we forecasted in the January outlook. Value-oriented sectors such as financials, energy, and industrials also joined in the rally, all outperforming the broader index. On the rates front, all eyes are now on inflation. Core inflation rose for the third consecutive month in March with a 3.8% year-over-year increase, sparking concerns that inflation may be more persistent than originally expected. Market now anticipates only 2 rate cuts for the year, down from more than 5 at the start of the year. This has resulted in the 10-year US Treasury yield jumping from 3.9% in January to 4.6% now. The increase in bond yields has negatively impacted their returns in the short term. US high-yield bonds returned 1.5%, while US investment-grade bonds and treasuries delivered negative returns for Q1. Heading into the second quarter, investors are grappling with questions about the Fed's policies, the sustainability of the equity rally, and geopolitical risks. We've identified the top concerns and provide insights to navigate through these issues. Question number 1. What happens if the Fed does not cut interest rates this year? We believe that while the timeline for rate cuts has been delayed, the bar for the Fed to hike rates remains very high. And even with the delay in the rate cuts, bond prices may not suffer greatly thanks to robust underlying bond yields. Currently, yields are at a 15-year high, presenting an attractive entry point for investors. Historical precedents such as in 1995 when the Fed kept rates higher for longer, bonds still delivered a total return of 26.4% over the next 3 years and 31.7% over 5 years. Question 2. Are the US equities in a bubble? US equities are currently valued at the high end, yet the emergence of generative AI could boost their long-term earnings potential. Comparing current AI advancements to the dot-com bubble, the recent rally has seen a 35% increase in 16 months versus a 250% surge in 55 months during the dot-com era, suggesting further potential growth. However, history shows that market downturns are common, with the S&P 500 experiencing an average yearly drawdown of 14%. Now, maintaining a diversified portfolio remains crucial for ensuring a smooth investment journey through periodic pullbacks in the market. Question 3. Will the conflicts in the Middle East derail the market rally? Now, geopolitical risks continue to be the focus. If tensions between Israel and Iran escalate into a full-scale war, the oil supply could be at risk. This scenario could drive up oil prices, potentially further fueling inflation. That said, the impact of war on equities tends to be short-lived. While geopolitical events often lead to sharp and short sell-offs in the equity markets, they usually rebound quickly, often within weeks. Investors may continue hedging their market exposures using safe haven assets such as gold, as well as use this as an advantage to capture the short-term price dips and add to their positions. Please stay engaged for further insights and don't hesitate to reach out to us with any questions or topics you would like us to address.